Good evening, everybody. Welcome to Zoom at 8. My name is Julianne Peterson, and I am your host every Tuesday night. We have been doing this for 5 years. I can't believe it. In fact, Jeremy Roll, who is here tonight, was with us back in 2020, December of 2020. A lot has happened since then, so we're excited about tonight's conversation. And I am also a loan officer for Old Capital. You know, we have been closing loans for 38 years. And in multifamily, 15 years. We are real specialists in multifamily. In fact, I believe Jeremy Roll has also been on our podcast. You might have even come to our Old Capital conference event. I can't remember, but we'll learn about that shortly. So listen, I want to be your lender of choice. So if you're looking or considering a deal and you're ready to put in an LOI, before you do that, let me take a look at it, because you would hate to put in an offer that's overpriced and then you have to go in and negotiate. That makes you look like a fool and you've lost all your negotiating power. So we're going to need your T12, a rent roll, an offering memorandum, and your underwriting. We'll take a look at it. We'll get with what's happening in that area. What does the appraiser say? And we will give you where the lending will be when it, based on those financials. Remember, your lender is your biggest partner. So build a good relationship. And when you have money on the line, you want to make sure you're with a lender that has a good track record of closing. So Old Capital, we do that. So tonight I am excited. Jeremy Roll is here. He's been here in the past. He is an amazing investor and has a lot to share. He started investing in real estate and businesses in 2002. That's 22 years ago, and left the corporate world in 2007. And that was 17 years ago, to become a full-time passive cash flow investor. Cash flow. We've got to talk about cash flow today. So he's currently an investor in more than 60 opportunities across more than $1 billion worth of real estate and business assets. As the founder and president of Roll Investment Group, Jeremy manages a group of over 1,500 investors who seek passive, managed cash flowing investments in real estate and businesses. Jeremy is also the co-founder of For Investors by Investors, which is FIBI, F-I-B-I, a nonprofit organization that was launched in 2007. And they're all over California. In fact, I went recently and heard Neil Bawa speak at a FIBI meeting up in Pasadena. So there's over 30,000 members, and Jeremy is one of the founding members of that, or founding investors of that. Jeremy also has an MBA from the Wharton School of Business and is an advisor for Realty Mogul, the largest real estate crowdfunding website in the US. So we are excited to have him back. A lot has happened since 2020, COVID. We've got inflation. We've got a lot of things to discuss tonight. So Jeremy, welcome back. How are you?
I am doing well. Thank you for having me. I actually can't believe how long it's been since I've been on this show. It does not seem like it was that long, but time flies.
I can't believe it. And I'm telling you, I've been thinking about this interview for quite some time. First of all, I don't know if you were under the direction of Peter Linneman at Wharton School of Business.
No.
Were you one of his students? Okay.
No.
I was so happy he came to Zoom at 8 and we had a wonderful conversation. And I always am impressed with people that come out of the Wharton School of Business. So tell us, everybody, a little bit about yourself. We've heard you're in California. You live in California. A lot of people don't buy and invest in California. Tell us a little bit about you.
Yeah, sure. So thanks everyone for joining today. Hopefully it'll be helpful for everybody, and thanks for having me on again. So I have been investing in passive cash flow opportunities as a focus, more stabilized opportunities and more predictable cash flow since 2002. And I really started that kind of my answer to like the dot-com crash, for those of you who are old enough to remember that. after watching the stocks go down just tremendously. I was sick and tired of the stock market due to the volatility and lack of predictability. So that's how I got into the kind of passive investing space and syndications. And I basically rotated all my money from stocks and bonds and cash flow between '02 and '07, and then got out of the corporate world back in '07. So I've been doing this full time for about 17 years, but been doing it over 22 years now in general. 5:16 p.m. I am very much focused on, there's 1,000 ways to invest. None of them are wrong. My personal box is definitely lower risk passive cash flow. And so for me, when I invest in real estate, for example, I'm typically targeting something that's stabilized, may or may not have any value add upside. That's optional. I want to go to sleep tonight, wake up tomorrow, and not much has changed because I live off the cash flow. So I tend to target a lot of tenant diversification. And I'm invested across most different areas of the US, across over 60 different opportunities. I don't invest normally in California. I have invested a little bit in it, but it's been years since I made an investment in California, and I tend to stay away from it because of the lack of cash flow and for other reasons. I'm invested across many asset classes, of course, including multifamily. One fun fact about me that's definitely applicable to this call is that I didn't invest in any floating rate bridge loan apartment deals. And so I'm sure we'll get into that, and it was really agonizing to not invest in those just because it was almost every single, I probably got 9 out of 10 deals that I got over across any asset class between 2020 and 2022 or 2023 were floating rate bridge loan apartment deals. But it didn't fit my box. But more importantly, I honestly did not think it was the right timing in the cycle to invest in them. And I can go into more detail as to why, but that was my number one guiding reason why I didn't invest in those at that timing. And what else? Multifamily is one of my favorite asset classes for sure for the long term. I am very skittish and very much on the sidelines in the short term. So I'm sure we'll get into that.
Yeah, great. Wonderful. A lot of details there. So you're in 60 deals now. What was the max that you've been in the past? And have you seen a lot of sales going on over the last 2 years?
Yeah, good question. So I actually don't know the actual maxes. I mean, I don't really count. I have a count with my accountant, all the K1s I have to get, but I've been in over 150 to 200 different deals since 2002, and I don't know the exact number. I tend to end up roughly in the range of like 60 to 70. Some things sell, some things are new each year, so it kind of changes. The biggest time of sale that I had, though, and I was really pushing sponsors to sell and lobbying them to sell with the little control that I have as a single investor, was between 2017 and 2020. So if you look at what was going on then, we had an inverted yield curve. We had kind of a recession writing on the wall. And had there not been a pandemic, I believe we would have had a recession in 2020 based on all the indicators. And so I was really pushing sponsors to sell. So I was actually in over 30 sales during that 4-year period between 2017 and 2020. That was the really bulk of when I was in a lot of sales, honestly. In the past couple of years, I've been in, I have to think about it, but I haven't barely been in any sales just because of market conditions, interest rates going up, et cetera.
So that is a good thing, thinking about some of the strong asset classes. So we're seeing retail as a strong asset class. We're seeing storage, and we're seeing industrial right now. What is your interest of those in the past? Has it changed now? Seeing some of the velocity of deals for those. Of course,
Sure.
not office. Huh.
Yeah, no problem. So retail, the last time I invested in a retail deal, I believe was 2015. And my thesis at that time was that wasn't an end of cycle timing thesis. That was actually an internet thesis where I look for predictability. So I usually get into a deal that's a 10-year fixed rate loan. That's my preference. I'll do 7-year potentially if it's early in the cycle, but I have to be early in a cycle to really get comfortable with that because I just want more predictability. So at that point, I was concerned about retail and the internet effect. And if you asked me in 2015, what will people be buying in person 10 years from now with the internet becoming more and more popular? I really couldn't tell you. And that was like the marker for me to really stop. So I will probably be looking at retail deals again, if and when we have some type of end of cycle adjustment that I think we're in the middle of, but we haven't really gone through fully yet. But I'm hesitant to do, we can get into specific reasons, but I'm hesitant to invest in retail going forward for a couple of different reasons. Industrial. So industrial, I I have invested in some industrial. I'm in a little bit of it right now, but generally speaking, it's been a long time. One of the reasons why is because I always had a lot of trouble being able to predict demand 10 years out because of the fact that the internet landscape, which uses a lot of industrial, was it was expanding. But Amazon, for example, was trying all different types of things. So where I lived before in LA, we had something called Prime Now, which most people have never heard of, which was actually Amazon delivering something to you in 1 to 2 hours, 24 hours a day. But that required local warehouses like near you, and not the large warehouses that you think of when you think of Amazon, 300, 400,000 square feet. And so I had no idea where the demand was going to be in 5 or 10 years. So I kind of laid off, but also I only invest in industrial parks with a lot of tenant diversification, say 13 or more tenants, just because I'm not a big fan of a single tenant triple net lease deal because it's an all or nothing proposition, which is not, doesn't have the diversification I need. So I'm not really looking at much industrial in general. I'll look at the odd deal if I have to, but like if it comes across and makes sense, but most of them don't have that many tenants. Self-storage. So I like self-storage a lot for the next 10 years. It's one of my favorite asset classes for the next 10 years. But I think the timing right now is rough for a lot of reasons, including which I do believe that if we have a recession coming up, I think some of the vacancies will go up a little bit and the NOIs will come down a little bit. I also think the cap rates haven't fully reset, but that's not just a self-storage thing. That's like an across all asset class thing. So that is one of my, say, top 3 asset classes once we have a reset, but not at this exact timing.
Okay, so you did bring up 2 things, recession and cap rates. So what's your thought on recession? Are we going into one? Are we living in one now? What do you say?
Yeah. I mean, I'm going to give you a random guess, but I think there's a 25% chance we're technically in one now. And I think there's a 75% chance we'll be in one in the next 6 to 12 months, which also means I think there's a 100% chance we'll have one, or almost 100% chance we'll have one in the next 12 months without, of course, never knowing for sure. I think it's a really high probability right now based on a ton of different indicators. And it's keeping me really on the sidelines as I wait to see what unfolds.
Okay. And what about cap rates? What are you seeing in cap rates? I mean, we've seen them,
Yeah.
really move over the last couple of years, and it's really difficult from a lender standpoint to figure it out. As an investor, where are you trying to figure out, you're doing your schedule of real estate, trying to figure out your values. What are you finding on cap rates, and what's your thoughts moving forward?
Yeah, cap rates are my biggest frustration because I feel like they haven't fully adjusted yet. And my guiding light for that is negative or positive leverage. And that, by the way, that's been the same. That's actually one of the reasons why I also didn't invest in any of the floating or bridge loan deals, because they were all negative leverage, which is never a good fit for someone like me. And in my opinion, without positive leverage, an investor like me is looking for that stabilized cash flow, is not getting rewarded for risk. And until I see positive leverage of, call it 100 to 200 basis points, hopefully 150 or more basis points, we'll be back at like historical norms where that's kind of where I start to get compensated for risk as an investor. And that's definitely something I'm paying very close attention to. So I think that the reason why we haven't had a full cap rate reset yet is because we haven't had a full end of cycle reset, which would include a recession, a stock market correction or crash, and a credit, crash is the wrong word, but like a really drawing in of available credit and liquidity. That hasn't happened yet, but it's actually following the normal recessionary playbook. And if we do have a recession, I expect all those things to happen. And that's, to me, the first domino of this end of cycle was increasing interest rates. That has a lagged effect. And the second domino is the recession, which has all these other effects.
Right. So let's go into negative leverage, because a lot of our investors here are new to what that means. A lot of them got in over the last couple of years and haven't really seen the influence from a passive investor's position. We see it from a general partner. We're trying to get our interest rates below the cap rate, right? But that's not happening. So can you unpack that just a little bit clearer for everybody, why it is so important that the cap rate be above, let's say, the interest rates in order for your returns?
Yeah. So just to define negative leverage as best as I can. So negative leverage is the concept that your interest rate is higher than your cap rate. And what that means is for every dollar you're borrowing to buy that property, the property is not actually managing to pay off that interest rate. because if you remove any debt whatsoever and you just buy something with all cash, the cap rate is the actual implied return of cash flow you're going to get, right? And so let's say you're getting 5% cash flow, but your loan's at 7%. That means that every dollar you take on is negative leverage, means it's instead of being positive leverage where you're paying a lower interest rate than the actual return on the property, you're actually paying higher interest rate than return on the property, which is not a good thing from an investment perspective. Now, of course, there are arguments to be said that heavy value add deals make sense despite negative leverage. I don't focus on those myself, but I still think that that's always setting you up for a much harder climb of a hill, and you're starting off at kind of a bit of a more challenging starting spot in terms of how things can go wrong. And so positive leverage as an investor means that you're actually getting compensated in a return, like a cash flow return, for a risk. And you're actually taking money out and you're positively leveraging that at a low interest rate than what the property is actually generating. That's a more comfortable place to be. It results in higher cash flow, puts less pressure on the property, in terms of performance to actually meet the debt service and the actual interest payments. So there's a lot of very important reasons why positive leverage is important. But for someone who's a stabilized cash flow investor, it helps to guide you as to whether things are too expensive or not, typically. The other thing I would say is that one other thing to consider if you're not familiar with this topic is that if you want to go buy a 3-month treasury as a passive investor right now, you can get about 5.3 something percent current, right? So if you go buy a building at 5 cap or a 4.5 cap, you're actually taking on additional risk where you should be getting a higher return than the quote unquote risk-free treasury, but you're actually getting a lower return. So you want to be looking at that treasury too, and always making sure you're getting a spread for the risk of taking on risk. And that spread should be somewhat significant, right? And that's about, we can talk about that further, but cap rates should be higher than that risk-free rate, but they aren't in many cases right now. And that tells you that things are still very expensive. We haven't had a reset.
Yeah, great. Thank you for spending some time on that. So you made a comment, and we haven't spent much time on multifamily. So let's kind of dive into that. What percentage of your portfolio do you like to associate in that asset, in the multifamily asset? Is there a certain percentage you want to be, you target, or is it just happen to be?
Yeah, great question. So first thing I'll say is just because of the amount of years I've been doing this, things just happen to be at the end of the day. But more importantly, if you're new to the space, really important to understand. If you're trying to create a very specific percentage over a long period of time of, let's say, any asset class, not just multifamily, you're trying to fit a round peg into a square hole, in my opinion. And the reason why I say that is because you are being reactive in looking at deals that you're finding. You're not making deals happen. You're not pulling them out of thin air. So you can only invest in what you find, right? And one thing I would, and I'm not a financial advisor or investment manager, but one thing I would definitely strongly recommend against is saying to yourself, okay, it's January 2026. I just woke up and I got to do 4 multifamily deals this year to make my pie work, because you may only find 2 that you like, and now you're forcing 2 others, and now you're not making good investments, right? And the opposite can happen too, and the other way around. And so I don't have a specific target per se, but what I will say is that what I've done in taking the experience I've had over all these years is saying to myself, for the next cycle, when I'm ready to position myself to redeploy a lot of capital, which asset classes are the best ones for me in terms of predictability right now? And my top 3 at the moment are multifamily, mobile home parks, and self-storage. Those are the ones, if you say to me, what's the demand going to be for those in 10 years? I have a better understanding of, or opinion. I have an opinion that I have a better understanding of where those are going to be than retail, office, industrial, and some other ones, for example.
Interesting. So I'm concerned. I love mobile home parks. I think they're amazing, but we're not building anymore. A lot of cities don't like that population. They're just not supportive. So how do you build that? How do you build your mobile home portfolio? And what are you doing to address that?
Yeah, so there's 2 challenges right now with mobile home parks as a passive investor. The first challenge is that pricing is still very high compared to historical. We haven't had the full adjustment of cap rates that I'm personally hoping will happen. So that keeps you on the sidelines. And that's been a problem now for many years, okay? The second is that we've had a lot of new sponsors come into the space, probably since about 2016, 17. And the reason why that happened is because that asset class was the last one that offered decent yield. So a lot of new sponsors were chasing yield and pivoted, say, from multifamily or other asset classes into that to be able to attract investors if they're doing more stabilized deals. So those are the two main challenges I see: is A, waiting for cap rates to reset to get that risk premium on the mobile home park side, just like any other asset class, and B, finding experienced operators going forward, which is going to be a challenge. That's in my view, because I can wait, but to solve for the other challenge of finding good operators is a little more difficult, right? That's what I'm most concerned about going forward. I would also caution you, if you're trying to learn about mobile home parks, there's a lot to learn. There's certain things to look out for. Certain sizes tend to kind of like trade in certain cap rate ranges. Smaller ones tend to trade on their own differently. And so you want to be aware of that. The locations are varying, but there's a lot to discuss. Percentage of park-owned homes versus owner-occupied homes. There's just a lot to learn now. So make sure you really educate yourself properly before you dive into that one.
So a little bit more on that. Are you interested in a combination of RV parks and mobile home parks, or specifically just mobile home?
My preferred is mobile home, because mobile home, these are non-movable,
Right.
homes that are put down, and they can be moved, but they're generally stationary for a long time. RV parks are a little more complicated. I would look at an RV park. Some RV parks are actually on an annual rental or lease agreement. Those I'll take a look at. Some of them are literally on a daily, and there's everything in between. And some of them are very seasonal, and some of them are not. There's a lot to look at on the RV side that isn't quite as complicated on the mobile home park side. So I'm open to looking at certain types of RV parks, but not a lot of them, because of the lack of predictability, and there may be too much turnover and people the 1 week or 2 weeks or 2 days type of situation.
Yeah, we've seen a lot of RV parks popping up. They're doing very, very well because of COVID. We've seen a lot of people moving, traveling and having this new lifestyle. But how long is that going to last?
Yes, and in fact, to be honest, RV purchases were very popular with stimulus money right around that
Right.
timing, and that created a bubble, and that created a lot of what I call temporary artificial demand. And that demand is, especially on the RV ownership itself, has really, really come down as far as like demand. I think that the actual RV park demand will come down over time the same way. So I think that you have to be very careful in that space right now, especially if you're looking at historicals for the past year or two. If you're looking at a property, you really have to ask yourself where demand is going to come from in the coming years, basically.
So one last thing on the mobile home parks, are you looking at them where they've got curbing and they have paved roads, or will you go and would you advise people where they're a little bit more rough? They've got, dirt for their paving, stuff like that.
Yeah, the dirt parks and the parks that are smaller and more rough, especially the larger percentage tenant occupied parks, those are a different profile than what I target. I tend to target less than, let's say, a maximum of 25% park owned homes, which are basically leased homes. I prefer to be much lower, as close to zero as possible. The returns on the type of park you're mentioning theoretically should be higher and appeal to some people and the right fit for some people. Definitely not for me, who is looking for more predictability and stability, possibly for a slightly lower return, but still a good return typically.
Yeah. Okay. Let's go to self-storage. Huge influx of new investors building these, getting involved. Again, COVID really ran this up.
Yeah.
Are you concerned? These are three of your asset classes that you are bullish about. I'm curious where you see storage going with all of these new developments that are coming
Yeah.
online.
Yeah. So keep in mind, everything I'm bullish on, I'm not bullish on today. I'm bullish on for the next 10 years.
That's great. That's a
Right.
big piece.
Yeah, I mean, that's actually the most important thing, because I'm really on the sidelines on everything today, except for really weird, unique situations, which sometimes there are. But so with self-storage, for those of you who are not familiar with the space, there's been, and I'm just making a generalization, like everything else, self-storage is local and very location specific. So there's been a lot of overbuilding in self-storage, which resulted in higher vacancy rates in the past 12 to 18 months, I would say. A lot of stuff came online, a little bit less demand as well, as the COVID effect kind of went down, and then there was less demand for units. And so between those two, it's been a kind of a tough go in mobile home park world since interest rates started to go up pretty much. And I do think that eventually, all that's going to be absorbed. But frankly, to be honest, self-storage is one of those asset classes you have to pay very close attention to, let's say 3 or 5 mile radius, depending on where you're, sometimes they're coming from further out, depends on the location. But you have to do a proper analysis of population to number of self-storage units per person, those types of ratios to see what's going on in that market. One challenge with self-storage has been and will always be that they're very easy to build. They're not expensive to build. There's low barriers to entry. So you could face future competition. So if you're looking at a market that's just on the like border line of like being saturated, you got to watch out for that because new units can pop up where you have no control over that quite quickly. And then all of a sudden you're in a bad supply and demand situation.
Okay. Excellent. All right. Well, before we go to multifamily, because many of our investors here are interested in multifamily, what about alternative assets? You've got gold, oil and gas, you've got car washes. What is your thought and support for any of those?
Yeah.
ATMs?
Yeah, I'm a big fan of diversification across as many things as you can get comfortable with. That being said, I think one of the most worrisome trends I've seen in the past, since interest rates started to go up, was like the anything but multifamily mantra, which also made people pivot to oil and gas and to other things. I'm not trying to pick on oil and gas, but you mentioned it, so not me. So oil and gas is one of those things that if you look at oil charts, and I'm not an oil expert by any means, but I do have an oil investment. But if you look at oil charts, you will see that oil goes down with recessions every single time. We went to negative $40 last time. And so, the bottom line is that investing in oil at the end of a cycle is very risky. And people pivoting to it at the end of a cycle, if you believe the cycle will actually now reset, is very risky. And I feel like people pivoted, but they're still pivoting. So just to make everybody understand what I'm trying to say, it's almost like we're sitting here in July of 2008 from a cycle timing perspective, and we're talking about what's great right now, what makes sense right now. And I would say almost nothing, right? That's one of those almost nothing asset classes that's quite obvious because we know based on the chart, oil goes down because of reduced demand whenever there's major recessions or worldwide recessions. So I would be very careful pivoting to other asset classes right now because it's almost like I've seen people pivot in 2006 or 2007 from multifamily to everything else. But does pivoting to anything else make sense at that time? I don't fully agree.
That is a big statement. I really appreciate you giving us your thoughts on that because I think you really hit it on the nail. What else other than multifamily? And that's why a lot of people are leaving or considering it, right? From an investor standpoint, a lot of people got into multifamily over the last couple of years and got into the bridge lending, right? And you were wise and didn't. So let's kind of dig into multifamily. What part of your portfolio do you try to get for multifamily? Do you have a percentage that you like to target?
No percentage. I just go with what I'm finding. And like I mentioned, it's going to be kind of what I call tier one, my top 3 asset classes targeting for the next 10 years, if and when I can confirm we get a cycle reset or not. But I do think that because I look for predictability of cash flow, and that means predictability of demand, right? So I look for personally like A- or B markets and A- or B asset classes outside of the very expensive markets like Los Angeles, San Francisco, New York, Miami. I don't invest in any of those because of the cap rates. I really look for more stability and some of the stronger markets. Some of the obvious ones are in Texas, clearly Dallas, Houston, and some other growth areas. And so multifamily is one of my favorites. You get a lot of tenant diversification. There's a ton of demand. As an LP investor, it's probably the number one volume of opportunities I can find, right? In other words, in a typical city, how many apartment buildings are there compared to mobile home parks and self-storage, for example, for my favorite? There's multiples and multiples more, much easier for me to find deals to invest in, right? So there's a lot of positive aspects that I like about multifamily. Couple of the big challenges coming up is the distress. And when you're looking at a deal, and if you're looking at it with a sponsor, what's that sponsor situation? Are they dealing with other distress? Have they had a foreclosure? Which, as you know, Julie, is one foreclosure and they get a different interest rate than everybody else. And now all of a sudden I have a lower return for the same amount of risk versus the next person, the next sponsor. And I saw that in 2008, 9, and 10, and so I'm going to have a lot of work to do as an LP, trying to sort out who I'm making a bet on and what shape they're in and really trying to confirm it before I move forward. Once the cycle resets, and I'm trying to figure out who to now move forward with again on the multifamily side.
Yeah, and I'd really be interested to understand now that you have shared with us that you didn't do the bridge loans and you're in longer term financing deals. People forget that those deals also are struggling from a rent perspective. It's not like, oh, it's only the bridge loans that have rent collection issues or any of that. So how are you finding the deals that have agency, the lender or the sponsors that you're doing deals with, occupancy, demand, rent growth, all of that? What kind of share with us your experience? Because a lot of
Yeah,
people are stuck in the bridge issue.
yeah. I'm honestly not a good example, and it's very simple as to understand why. So the only I have not invested in a market rate multifamily deal, meaning just a regular normal purchase, even off market, but just a normal building, probably since 2016. Everything I've done since 2017 was defensive, assuming a recession was coming up within the next few years. And in 2017 to 20, the only multifamily investments I did were low income housing tax credit. And the reason for that is because those tend to do better than average into a recession and are much more stable in a recessionary time and just in general long term. They have pros and cons, but that's the way I looked at it. And then the tax abated deals became more and more available around 2018, 19, 20. The only thing I've done since 2020, and I actually invested in even one or two this year already, is tax abated multifamily deals. And so the reason why I bring those up is not only were they a defensive play with a lot of uncertainty, eventually waiting for a recession, but they created a ton of positive leverage on a typical deal at closing initially, which is why they made sense to me. They also tend to position you in terms of the income restricted units for strong demand, even in a recession. So they're not as susceptible to having higher vacancy rates in a recession, which is a defensive play. And there was a lot more cash flow day one because of the positive leverage. So, and though, by the way, those tend to qualify for agency at the right occupancy rates pretty readily, right? And so, and in fact, you get a pretty strong LTV. I don't like overdoing that, but you get a kind of unusually strong LTV based off of the tax abated structure, assuming you're going to a deal that's being converted to tax abated, which is what I typically do. And then you get the real value at pop without any operational risk or execution risk. So you're talking to someone who hasn't invested in a regular apartment deal since the end of 2016. It's a defensive play into a recession 2020 or a recession coming up. And so I'm not a good person to answer that question right now.
But I would tell you, a lot of people made a lot of money from 2018 to 22. I mean,
oh, I'm sure.
huge.
Yeah. Oh,
and
yeah.
your decision to not invest was a big and strong decision. Do you look back and say, I missed out? That was not a good decision. What's your thoughts?
Yeah, like during those times, I would tell you, and I'd still tell you today, there are plenty of people who made a lot more money than me, for sure. But two things though, that it's an agonizing wait. I'm not going to lie. Like in 2005 to 2008, I sat on the sidelines of the multifamily, and I said there was going to be a housing crash. I was very young. I go to parties with friends, and people would think I was crazy. And it waited 4 years until it's a very long, agonizing wait. I watched the exact same thing in 2020 and now, which is still going on because we still haven't had the full adjustment. But I've been pivoting and doing things that I think make sense instead, and actually then focus on treasuries and just not having to force the investment. So you have to have a ton of patience. But generally speaking, I try to stay away from the FOMO, and I do get caught up in a little bit. I did a tiny bit of Bitcoin that kind of did okay. I did, we didn't mention, but right now I'm actually long silver because this is the one time of the cycle to do it. I do a little bits and pieces of stuff. I'm in a lot of different alternative things beyond just the cash flow, but it's a small percentage of my portfolio overall. But the bottom line is that, yeah, I'm just not the right risk profile to take that short-term risk. And I'll go back to what I said before. The reason why I didn't do those either in that time frame is because you look at yourself and you say, we are in a record long economic cycle. Yeah. And I used to literally say to people in the past years, if you believe cycles are now done and won't ever end, and now there's no more cycles, then just keep investing. But if you believe cycles exist, you are taking a short-term lending timing risk on what we know it will eventually end, and we don't know when, right? But I just knew we're in a record long cycle. I have no business making a 3 or 4 or 5 year bet that I could be comfortable with personally.
Well,
Everyone
and
has to
you
do it.
you 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 did tell us that in 2020. You said
There you go.
yeah, you were
Yeah.
definitely sitting on the sidelines and concerned that it was a long time that we were in this cycle. So
Yeah.
you're
And by the
still,
way, the stimulus money just ended up delaying the end of the cycle, right? I hope everybody
yeah.
understands that. That's my opinion, but the most likely scenario. We would have had, like I said, that recession back in 2020, and it got delayed these few years because of all the money printing.
Okay, so we've seen the Sunbelt states in multifamily have a ton of new construction, absorption, rent control, or rent issues. Hey, and we also have this situation that came up today with 5% rent increases a month. That's, or a year. We're not going to deal with that. But what is your thoughts moving forward, considering deals in multifamily? Are you staying in the Sun Belt, or are you looking at assets that are closer to the Midwest,
Yeah,
even Florida? Give
great
us your
question.
thoughts.
Great question. So again, I have to think 10 years out in terms
Right.
of demand. So what I try to avoid is the Midwest look. I have no problem with the Midwest. I have investments in the Midwest. I'm not picking on the Midwest, but I know right now the Midwest is interesting and hot, but that is a pivot. Okay. To me, that is a short-term pivot. Now, again, if you want to invest in the Midwest for many, many years, I know people who do it very successfully. And frankly, I love the fact that there's not a lot of up or down in values in the Midwest because I look for that stability. I don't want necessarily huge gains. I just want stability and predictability of cash flow. So it's not a bad place for me to invest, but I am not chasing Midwest today because it's today and because other markets don't make sense and they're overinflated. And actually, one thing I would almost equate the Midwest to an extent is how far out from a city center someone's willing to invest is typically proportional to how long we've been in the cycle and how long it's gone on for and how expensive the core areas have become. So people chase yield into the C areas and the Class C deals, and then eventually that all changes and it resets, right? And I feel like the Midwest is the same thing where people are now leaving some of these areas to chase that yield, but eventually it could reset in terms of demand. Not necessarily fully fair. You have to analyze each deal in each market separately. So there may be some great deals or whatever, but do be careful in that this could be a kind of a short-term pivot. And I am not the investor that is chasing areas and kind of going short-term and flipping this and flipping that. I'm trying to figure out what is going to be stable and predictable for 10 years.
Yeah, I mean, that's like, starting in Dallas and going out to Waco and Lubbock and Midland. And those
Yes.
they can be good, but you have to be very careful because, as you know, Midland and Odessa, that's going to be dependent on the oil and gas.
Yes. And I want to say that the problem for those of you who haven't been through cycle is that people going out to Lubbock and all those areas, eventually they're doing that because it's too expensive in Dallas, say, right? And then, or Houston or whatever it is. But then eventually when things become cheaper, they're going to go back to Dallas and Houston because that's where the demand, like the population growth is. That's where the higher demand is. And they can get as close to a good deal in a better market. That's where they're going to go back to. So try to avoid going out to those tertiary markets unless that's your specialty temporarily or trying to chase yield because that is cyclical and it will change.
That's great, great, great point. So let's talk about Austin. Austin was the capital place to be buying assets in multifamily, if you could afford it, right? Everybody was paying a lot of money. These investors could not end up getting in deals. Let's go build. Now it's saturated. What's your thought? 10 years, are you gonna look at Austin?
Yeah, I will revisit Austin. I've been very close-minded to Austin for a while because being in California, I saw, I mean, Austin was a huge destination and got run up very, very obviously and very quickly. And as soon as something like that gets run up, I have to stay away from it from a valuation perspective. It becomes like just cannot make sense to me. But long-term demand, I mean, I know there's been an adjustment, especially on the housing side, single-family housing side there. Long-term, that market's still probably strong because it's going to be one of the larger markets in Texas. And I think Texas is very strong long-term. So I'm going to revisit it once we have some type of, once I can determine for sure if there's going to be a reset or not. But I would caution people that if we do have a reset, a market like Austin that's kind of been overdone, it's like everything has to revert to the mean, and Austin went way out of the mean. So now it's more susceptible to reverting, and it's happening on the single family side. You have to be careful on the multifamily side and just don't get caught, trying to catch a falling knife where it actually hasn't fully reset yet.
Yeah. So with that said, would you buy a single family in Austin? I mean, or anywhere. What are your thoughts on single family?
Yeah, great question. Single family is tough for someone like me because I like to be diversified across a lot of properties, and I haven't come across a buy and hold, not like build to rent, but proper stabilized portfolio in a long time. One of the
Mm,
reasons why that hasn't happened is because once the interest rates went up, the positive leverage in that and making sense of that became very challenging in combination with prices rising very, very quickly. So right now, that is not a good place to look, in my opinion, based off of very low affordability, record low affordability, which means that we're probably at peak pricing with houses. I'm not saying there's going to be huge corrections everywhere. That affordability can come back into play by going sideways for a lot of years and catching up on the income side, which is, I think, the more probable scenario, unfortunately. But I really think that right now is a very challenging time for because of the low affordability in a lot of housing markets,
yeah,
meaning prices are very high.
yeah, absolutely. You mentioned you're not doing value add. Did you do value add before and learned from it? Have you never done value add? And from a investor's perspective, or really from a general partner perspective, in this cycle, where's value add? Is it, in my opinion, it's very risky. What about you?
I think value add at this part of the cycle is extremely risky because, going back to my opinion, it's like you're saying, is value add good in July of 2008? My answer is no, but that has nothing to do with value add. It has to do with everything, right? But in particular, value add, because that requires some runway for you to be able to take off. And right now we're at the end of the runway, most likely, right? That's the challenge. And that's always a challenge when investing at the end of a cycle. You just have less runway left before you have to take off. Beginning of cycle gives you the max runway. And that is the time in which I will look at value add deals and be more open to them. That being said, they're not the right personality fit for me. So they're a great fit for many people. And again, those people will probably get a better return than me, truly.
Yeah.
But it's a personality fit call. So for me, I might look at a little bit of value add. And I'll also just define a little value add on the multifamily side for me. I will do minor value add deals in kind of beginning of a cycle. What I mean by that is an operator coming in, redoing the cosmetics of a unit, not forcing tenants out at the end of each lease, but turning them when the tenant goes. It could be in 2, 3, 4 years, a slow process. So not forcing that appreciation and just keeping it as stable as possible for the cash flow in the meantime. If I can get comfortable with the experienced sponsor executing on that at the beginning of a cycle, I'll take a look at it. But a more major value add play or medium to major value add, that's where I get out of my comfort level from a risk perspective.
All right. So you've been doing this a long time, 22 years. You've learned a lot. So if you look at it in chunks, you got 2 years, 5 years, 10 years, 20 years. If you look back at 20 years and today, how you're valuing each of those assets, what has changed? What has changed? What have you learned? What is your biggest takeaway for those people in the room in today's market? What would you tell them?
Yeah. Well, a ton has changed, which is almost too long to discuss. But I mean, when I started investing in 2002, there was no smartphone. There was, barely high-speed internet, literally.
Sure.
So you can only imagine how much has changed between crowdfunding, smartphones, data wasn't accessible to investors before, just so many different ways. What I would say is that one major change that we saw was a ton of, accredited investors come into the space because of crowdfunding and some public solicitation laws like 506C rules as of about, 2012 to 15 and on. So now there's a lot more money, looking at these types of deals. I would say that one thing I would, and again, I'm one person's opinion, I could be wrong, but the one thing that concerns me the most about what happened this cycle is that if you're an LP investor trying to invest between 2020 and 23, 90% plus of everything you got was value add bridge loan multifamily deals.
Yeah.
I think we can all agree that the vast majority of those are either underperforming or in distress right now. And a lot of those investors are new because there was stimulus money, a lot of people chasing deals, et cetera, just a lot of money going around. Mm-hmm. So my thesis and my concern is that there is a major concentration of people who, a lot of whom are new, who are going to have very bad experiences, are going through that right now because of their timing and other reasons. And I believe it's going to be probably even harder to raise funds on a non-institutional syndication side once we have this full reset, because it's so concentrated on where people are going to, such a high percentage of people invested in these types of deals, and they're going to get hit in one way or another, that a lot of them are just going to walk away and not want to invest in this space compared to a normal reset, which is, I think, much more diversified. And so you can argue the same for single family in 2005, 2008, but not in the syndication space. That was actually going and buying the individual homes. This is different, you know? So I think that fundraising is going to be very challenging, probably for at least 5 years or 3 to 5 years after we reset in this cycle. I think that prices are going to adjust partially because the demand won't be there as much, because the money won't be there as much on the non-institutional side in any event, which affects certain price ranges of multifamily properties, certain sizes, certain markets. And I think that that the number one challenge a sponsor is going to have is going to be fundraising. And I think it's going to be harder than normal, even after we've had a end of cycle reset, which is already hard. I think that a lot of people probably aren't thinking about the fact that we would normally expect to have, if we have a recession, a very large stock market correction. Unfortunately, given the fact that the yield curve has been inverted for a record length of time, there's actually a direct correlation between the length of inversion of yield curve and the amount of adjustment in the stock market if we have a stock market correction based off of a recession. So if you actually plot it on a chart, if you look at historical, we are at the lower scenario expecting a 30% correction, and the actual amount that I would expect, the more likely scenario is, I know it's very difficult to picture this, even I have trouble picturing this, 45 to 50% stock market correction is the highest probability, in my opinion, just based on the charts, right, from historical. If we get that type of correction, you're going to see a lot of money leave the space, period. And it's going to be a very big reset, along with that other, kind of almost compounded by the other challenge I mentioned, especially on the multifamily side. So I think what this is all going to mean is that there's going to be very difficult to fundraise, but a lot of good deals to be had. Because when you have more supply and less ability to buy or demand, there's going to be much better cash flow and a lot better deals probably in the next 1 to 4 years than there is today. And then the other thing I'll leave you with as well is real estate moves much more slowly in the stock market. I would much prefer to be a little too late than too early in real estate as an LP. And so patience is very challenging, but in my opinion, that is very important to keep in mind. I'm in no rush, because it takes a long time for everything to reset at the end of a cycle on the real estate side specifically. So I'm looking forward to being able to redeploy, but it's it's in the middle of the agonizing wait, essentially.
Well, you're still smiling, so that's good. There's a lot of people that show up for, conversations, and they're just, it's tough.
If you have the patience, it's cyclical. So why I'm smiling is because I know I'm closer than ever to the actual opportunities than I have been over the past few years. It's been very frustrating, and I know it's coming. There's a rainbow and there's an end to the rainbow. It's there,
Yeah. So what's your top performing asset class at the moment?
Well, okay, you're talking about cash flowing asset class, because I've been in.
Yep.
Okay, I've been in some startups that have like a very high multiple.
Yep.
With the exception of some hiccups recently, I've been invested in ATM space since 2008. And if I look at recurring cash flow across a couple of different sponsors, on average, I probably actually realistically have earned about, I haven't run the numbers recently over the last year, but just call it about 30% annualized since 2008 of cash flow, of predictable cash flow on average in that space, maybe slightly, maybe 29 or 28. That's been my number one, like most, highest performing, most longest term, most predictable. I've done very well in some older mobile home parks. For those of you who go back this far, 2009, 2010, I mean, it was actually, the market rate was 10 to 13 caps on kind of mid-range, mid-tier, like 3-star kind of class B parks in Dallas, for example, in good markets. And so you could only imagine at that time, if you went into some of those, which I'm in a whole bunch of funds, those have done extremely well, especially from a total ROI perspective, and some of them cash flow very well right now. But everything has changed. There was a ton of money chasing deals for far too long. We got the money printing, which extended an already record long cycle. This is so overdone, and that will change. But at the moment, it's very challenging.
So last question for me, distressed assets. Are you thinking about buying those? Is that on your radar?
So, it's funny. I had a conversation with someone yesterday who was like me, kind of a lower risk investor. And I said to them, don't you agree that if you go into an 80% discounted office building in San Francisco today, that 5 years from now, that'll be really obvious, right? And he said, yeah, but I don't know what's going to be done with it in the meantime. I said, yeah, that's why I'm not doing it either. There is going to be great distress deals. The problem is whether or not you're the right risk profile for it. So I'll probably go into a few opportunistically, but most of my money always goes into cash flow because I live off the cash flow. I have to deploy as much as possible into cash flow to keep it going. So I'm still going to go majority into cash flow.
Okay, awesome. All right, lots of questions. Paula's had her hand up the entire time. Paula, did we answer any of your questions, or is there any one that you absolutely have to have?
Yeah, I'd like to know about, he's got what, 60 plus LP positions? I mean, how does he keep up with that? Is that a spreadsheet? And also what kind of masterminds is he a part of where he meets his network of investors?
Right.
Yeah, so good question. So my tracking for my opportunities is very rudimentary. It's a very basic spreadsheet. And what it does, I try to go out 10 years or a little bit more. And when I go into a new opportunity, what I do is let's say there's an annualized projected cash flow return for year one. I'll divide it by 4. I'll then plug it into the exact month that based on when that sponsor does distributions, when it should come. And then I just have a cash flow of spreadsheet I can follow. It's like, what am I supposed to get this month? And what does that look like? And that's how I track it. It's really nothing fancy at all. And then the other question was, remind me again?
Networks, where you find your investors.
Yeah.
Masterminds.
Yeah, I don't do too much in the way of masterminds. I think it is helpful for a lot of people. I just don't personally do them that much, but there's absolutely nothing wrong with them. I do a ton of networking. So at this point, I have the advantage of having been in the space for many years. And when you have that advantage over time, your network just gets bigger and bigger if you're really proactive about it. So the networking for me is kind of easy now because I get a lot of people coming to me. And I do still network with a lot of people proactively, but it's a lot comes to me now. And that's just based off of time. So when I first started, there was none of this Zoom. There was no virtual meetings. I was in LA, and fortunately I was in a big city. So there were a lot of meetings. And what I would do, I would drive, I was not married and I had no kids. So I would drive to 2 to 3 meetings a week on average, which is a nightmare in LA traffic for years, basically networking, finding people to talk to, finding opportunities. And eventually it became easier with podcasts and this type of thing. And conferences really existed a little bit, but not even to the degree they do now. I love conferences, very efficient. If you go to a conference, so Julie, I have been Old Capital a couple times as speaker. Yeah. I'm actually going to be a speaker at Old Capital in October, so I'll be there. And for those of you who have not been there, and I'm not paid to say this, it's really I love what they do, what Julie does, what James does. It just, they get really good speakers. It's no sales pitch. Especially if you're focused on Texas investing specifically, great place to go. You'll meet a ton of good people, and it's just such a good, probably 400 to 600 people. I'm guessing such efficient networking in that type of environment.
Yeah. Yep. Thank you. Now, are you still in LA? It sounds like you moved. I'm concerned.
I moved 2 years ago to near Newport Beach, so I'm now theoretically in Orange County.
Okay.
So I'm not that far, but I'm not in LA anymore. It's totally different here.
Well, closer to me. And I just rode my bike from Newport up to Seal Beach. So I'll wave the next time I do that.
Okay.
All right.
I'm in Irvine, just so you know.
Yeah. All right. Listen, does anybody in the room, this is an opportunity. These are the live conversations that we have with industry experts. It's open to you to ask the question. Hector, what's the question?
Hi, Julie.
Hello.
Hi, Jeremy. Thank you so much for sharing your knowledge with us. I had a quick question. You mentioned that always mighty and necessary spread between your cap rate and your interest rate. What kind of spread do you shoot for typically?
Yeah. So historically, based on historical, I can get really comfortable at 150 basis points or higher. The problem is that you're not always going to have that opportunity. So the one thing I have to be cognizant of, and this is really important, is that I can want 150 basis points all day long, but if it doesn't exist for 20 more years, I'll never do anything, right? Yeah. So I have to really go with what the market's doing. I would say that it's going to have to be over 100 basis points or higher. I'm always going to be very suspicious as to whether we've had a full reset or if I'm really getting compensated for risk, if I should look for something else,
Got it. Thank you. Appreciate that.
Bob Evans. Bob Evans, the restaurant, good restaurant.
Yeah, I wish. Then maybe I could be a sponsor. Maybe, I don't know. Thanks so much, Jeremy. This is great information. Really appreciate everything that you're telling us here. But you mentioned a lot of different assets. What do you think about assisted living?
Good question.
I think assisted living theoretically sounds great because there's very predictable upcoming demand over the next decade. And it's something I've been focused on since about 2015-16, because the demand going up from 2022-23 and onwards, there's just a huge spurt of projected demand based on the aging population. I have been in a few assisted living deals, and I will warn you that the operational execution of assisted living and all the other kind of within that space is very challenging. Stuff like independent living, 55 plus apartment buildings, those are a little bit different. But when you get into true assisted living and some of the other, classes within that, there's a lot of regulation by state. There's a lot of hiccups that can happen. COVID was a huge nightmare. And I don't know that's going to happen again in the next 10 years. I'm not necessarily. But there's a lot of hiring challenges. There's a lot of staffing shortages. There's a lot of minimum wages. There's a lot of challenges in that space. So I would be just careful with that particular space going forward. And if you're going to go into it, just make sure you're diversified across a lot of different deals, just to be sure.
I just cannot pass up the opportunity to ask Jeremy a question. Great to see you, man. I really appreciate all you do. So for us passive investors, this market has changed quite a bit. I'm curious how you manage those operators that aren't doing so hot. So how much time are you giving them before you're picking up the phone, before you're starting to call some of your friends? Give us some insight as to how you're handling the management part of the assets that you own.
Yeah, so I have a kind of a rule of thumb for myself, which is based on the target cash flow, the projected cash flow. If we're either 20% lower or more further down, or 20% or higher above what was the projected cash flow, I try to understand why. And so even above, I want to understand why. Like, what has happened? What can I learn from it? What is going on, right? So on the downside, if we're below more than 20% the projected cash flow, I'll try to look into it. So for example, and Julie, we didn't really get into this book before, but you did ask me, you did mention it. So in some of the stuff I'm in with 10-year fixed rate loans, like you said, there's been insurance cost challenges. There's been some, new supply challenges, et cetera. So some of the stuff I was in that was maybe at an 8 or 9% cash flow prior is now maybe at 6%. Yeah. Okay. And that is a 20% adjustment, right? But I understand why. So I'm not as concerned about it. In fact, one of the sponsors I just caught up with the other day that I'm with, this is very interesting, by the way, just a little, they went apparently overseas for finding, for I don't know what reason, but finding new insurance. And they were able to reduce their insurance bill by 30 to 40%. I don't know what they did or how. They're a multi-billion-dollar owner. They're very big, but and so that's going to have a huge impact on the cash flow going forward, and that's going to go back up. But that did come down, right? So Andy, to answer your question, if things are more than 20% below the mark, I'll basically really look at the reports, talk to the sponsor, try to understand why. On the real estate side right now, I'm in one property that is having challenges. There's always these 1% risks, everybody here. I was in a 10-year fixed rate loan on a retail deal, 2014. We were literally under contract to sell the property prior to the loan expiration in June. And in May, as we were about to close, the main anchor tenant, 99 Cent Stores, which is a very well-known, said that they announced they were leaving all their locations in California. And that deal blew up at the last minute. And then we had 1 month to try to figure out what to do. And now they're kind of paying the loan current, but now the loan is due. And so I don't know how it's going to all work out, right? With that, I'm just speaking to the sponsor once a month and just finding out what's going on, because I just want to make sure they're on top of it. There's not much I can do as an LP investor, right? So that's just one example. I'm not dealing with like we talked about before, I'm not dealing with the apartment bridge loan, fixed rate, like rate cap. I'm not dealing with any of that. So I'm not a good perspective to really give you a good answer on that at the moment. But that's how I handle just generally high level.
Yeah, good point.
Julie, I'm having an issue with I cannot raise my hand. Can I ask a question?
Oh, sure.
Hi, thank you, Jeremy. My first question was about tax embedded deal. So I would like to know would you please explain the rationale for these? Because those deals, when I look into them, some of them can be some type, like when they give in the tax abatement, it's only for a certain amount of time, let's say for the first 2 years or the first 5 years. So what What's the reason? I don't know if we explained that, but what's the reason you go for those deals?
Yeah, so tax abatement is changing a lot as we speak. I think they're cracking down on it a lot, especially in Texas in certain areas. Meanwhile, it's actually popping up more and more in other states. So there's opportunity in other places. So it's very dynamic and changing very quickly. The deals I've been in have been 99-year term deals. Almost all have been 50% income restricted. Almost all of them have abated all the taxes minus some fees. So the effective, savings about 85% plus or minus on average. And I've stuck to those. I've also been careful because there's always been a very significant positive leverage spread in the deals I've done. I've seen some tax abatement deals that, have a decent abatement terms with the local housing authority, but because they're paying too much for the property, the positive leverage isn't really there as much. And so those aren't as interesting to me because then, what's the point of overpaying for a property and getting the abatement if you're not getting the full risk reward for it, in my opinion, right? So you do have to be very careful with that, but I would be very careful with the tax abated deals right now because to your point, things are changing very quickly and the doors being closed on a lot of them very quickly. I think if you fast forward just 2 years from now, there'll probably be a lot lower volume of opportunities in that particular space. But at the same time, by the time that happens, theoretically, market rate deals, meaning non-tax abated deals, will hopefully make more sense because they'll have their own positive leverage because prices will have reset.
Okay. Thank you.
A lot shared tonight. And I just want to thank you again, Jeremy. Great information shared with everybody to kind of figure out where are we going for the future, especially for passive investors. I think we're going to run into some challenges. And that is Jeremy's in it for the long haul. You and I need to be in it for the long haul. It's not a get rich quick. So again, thank you, Jeremy. I appreciate it.